Well, I got a request to review Build-A-Bear Workshop, ticker BBW, which it's kind of crazy that I'm actually reviewing this stock, but let's check out some of the numbers, shall we? So I have them pulled up in TradingView on a 5-year chart. They're up 429% in the last 5 years. Very good performance, I guess, in the last 5 years, which is interesting. And then the all-time chart is something that I want to focus on here. Back in 2005 to like 2008, during the financial crisis, it really took a hit. And then it finally started to recover in 2013, and then it was downhill from there. And if you would have bought in like 2020, man, you would have made out like a bandit. Um, but yeah, you could see that this business is kind of cyclical. It looks like it really has to do a lot with the strength of the economy as a whole. So are you buying a good business at a fair price, or are you buying a cyclical business at its cyclical top? So that's what we're going to try and figure out today. It is a $414 million company, and its price to earnings ratio is only 8. So really good earnings for its price. And they do have a little bit of a dividend yield. Their dividend is actually higher because they do pay special dividends, and usually that doesn't show up in the dividend yield. Yeah, here's a little look at what they've done the past 3 years, which they've held a 10% net margin, which seems like what they're aiming for, and their net income has held pretty steady, with a growing revenue actually. We could check out their numbers a little bit more closely here, and I'll zoom this in a little bit. Okay, here is their revenue on an annual basis from 2017 up to 2023, and we can see that it has grown. In 2020 here, when people were stuck inside, it really dropped off a cliff, and then it made a really, really nice recovery into 2021. So can we expect this growth to continue? Well, maybe actually. It's possible that this growth does continue. I wouldn't really expect it to be like really high growth, especially since last year they only grew by 4%. So we'll have to watch out for that. Their income is really good when the economy is doing well. But in 2020, when their revenue took a massive hit, they actually had a net loss. So yeah, that's why this business is so cyclical. Let's take a look at their balance sheet here. And for their most recent quarter, we've got net debt of 39 million. And it looks like they have been paying down debt, maybe so that they're prepared in case of a cyclical downturn. Yeah, we can see that their debt has been going down, except for maybe 2018, they actually had negative net debt. Maybe this was when they started to grow the business or something. I don't know, but now their debt is pretty low at only 39 million. So they could pay that off in 1 year with their earnings. Cash flow. Cash flow. They bought back some stock last year, about 25 million, and they paid some dividends as well. Let's check their stats really quick here. Their return on invested capital right here. For the past 3 years, it's been 29 or 28, so really, really good. But before that, it was really bad. And then net margin. So net margin and return on invested capital usually have a pretty high correlation. So that's kind of what you're seeing here. The net margin is about between 10 and 15%. Let's check out one of their slides. So this is one of their slides. Okay, that's better. This is one of their slides. They're expecting 2023 to have, well, wait, 20. Okay, I don't know why, but they're like behind a year. This is their most recent presentation, I swear. They're looking for like a plus 5 to 7% increase in revenue for next year, and their income to increase 10%, which seems optimistic, I would say. And looks like plus 20 to 30 experience locations, so they're looks like they're looking to expand. So I guess that's what we can gather from that. Let's take a look at the analyst estimates here. Zoom that in a little bit. And the average estimate is 362 a share and then up to 385 next year. There's only 3 analysts here and 2 analysts here, so not a big sample size, but it's something at least. And then their revenue estimate 504 and then increasing by 3% to 519 in the following year. I put that into the DCF model that I've got. Let's check this out. So I put all these numbers in here. 3.62, you got 504 million in revenue, 20 million in buybacks and 39 million in net debt. Discount rate of 10% because I want 10% return. Exit multiple actually is way too high. I think 22 is way too steep for this business. I think since they're trading at a multiple right now of just 8, I think an exit multiple of 10 is actually more fair. So that I think that makes more sense here. Here I've got them growing their earnings per share by 3% a year. And the fair value would be $37 in that case. And with them trading at $29 right now, they would be a buy. And then with the revenue one, I have their revenue growth of 3% and their profit margin staying steady at 10%. So this basically is if they can continue what they did for the last 3 years into the future in perpetuity, then they are worth $38 a share. And it's possible that they grow more than this, but it's also possible that we get another downturn in the economy and people aren't able to go and spend on these expensive bears, basically. In that case, it's possible that maybe 1 or 2 of these years have like no profit margin or even negative profit margin. So that's something to watch out for. So this is rosy. It's not really a stock that I like to buy. I don't really like companies with charts like that where they have really big drops and cyclical downturns. If if we do get another cyclical downturn like that, then I would consider adding them because I know that it's just a matter of time before they recover. But at this point, I don't want to be buying at a cyclical top. Like I said, it's possible that with this all-time chart, we're looking at a cyclical top. Like after this run, you buy at the top and then you're losing for the next 5 years. So I just don't want that to happen here. Because it's definitely possible that we go into a cyclical downturn and the stock ends up just getting crushed. So that's why I'm avoiding it, because of the risk involved. Oh wait, you can't even see that. My bad. Yeah, right here. So that's the cyclical top right here. Here's the cyclical top. Here's the cyclical top, and then the downturn takes you down, like minus 80%. And I just don't want that to happen to me. Anyway, I hope you guys enjoyed the video. If you did, hit that like button. Otherwise, leave some comments in the comment section. Any questions are welcomed. And if you want me to review a stock, make sure to let me know. Yeah, I'll see you in the next one.